Hey, what's going on, guys? Welcome back to my channel. This is Blood Phantom 81. I know it's been a while since I made a video. The audio is probably not going to be too good. I'm just making this real quick on my laptop. So I haven't been active on YouTube lately and expect that trend to continue, honestly. I'm probably going to be taking a break for the foreseeable future. I'm not going to put a date on exactly when I'm coming back, but yeah, that's how it is right now. I did want to sort of give a quick update on what I think is going to happen with the stock market and how I'm positioning myself. I figured that my advice or my opinions might be interesting to some of you guys. I know I have a little bit of subscribers who have been tuning into my videos. I know I've had a couple of you guys ask like where I am and stuff like that. Yeah, like I said, I'm just gonna be busy for the next I don't know how long. But yeah, so I wanted to give a quick update. Generally, I think the majority, as far as I've seen right now, think that we're in a counter trend rally within the context of a bear market, and this bear market is just barely starting. Personally, I'm a little more optimistic than that. I should say a lot more optimistic than that. I think it's possible that we continue to see volatility in the short term, but I'm still bullish this market despite everything that's going on. I know that sounds kind of crazy. I don't particularly like to pretend there's a huge correlation between the economy and the stock market at any given point in time. And I think trading based off of headlines and the latest news report isn't the best thing to do, honestly. That's just been my experience. And again, take that with a grain of salt because I haven't been trading for a super long time either. I don't know if you guys actually know this, but I think I started doing this new trading strategy as of the end of 2017. So it's really just like 2 to 3 years in the making, but it's just been morphed out of basically what I see happening in the world is the input, and then I process it in some way and try to make sense of everything and try to figure out what actually matters, and that's my output. And it turns out that a lot of the noise and news, I used to take that very seriously, but I'm starting to take noise and news a lot less seriously, and I think it's a lot less important than most people are giving it credit for. So there's a few things that I focus on whenever I do make my trades. Um, and that's pretty much, I try to gauge sentiment, I try to gauge supply and demand. Those are basically the two things. Right now, I still think there's a lot of fear. There's a lot of hesitancy in the equation. I think retail probably doesn't want to get super leveraged right now or super into stocks right now. People are just waiting. And as far as like social media websites go, I think the vast majority are bearish right now. And so yeah, so let's go ahead and take a look at some data points. The first thing I want to do is actually look at the overall stock market because it's been quite the rally actually. So this is the Nasdaq E-mini futures over the long-term time frame. This is the 200-week moving average, which is probably the most important moving average when it comes to determining if we're in a stock market recession or not. And as you guys can see, we actually held that area to the penny actually. And ever since the 2009 bottom, once we reclaimed this moving average, we haven't gone below it ever since. Of course, this is the 2008 recession right here. Let me go ahead and zoom in. So it held that support for a little bit, and then we bounced up for a bit, and then it held that support again. We got a smaller bounce, and then it just plummeted once we broke below it. So it was significant here in 2008. And then if we go back to about the 2000 recession, I'm actually, okay, so NASDAQ E-mini futures won't go that far. But I can assure you, on other NASDAQ charts that I've seen, it's a pretty similar story actually. Once we plummeted below the 200 moving average, and on TradingView, it doesn't go back that far, like I said. But yeah, once we plummeted below that, then it was sort of off to the races to the downside. So obviously that didn't happen. I think that's a pretty good line in the sand as far as like short-term trades and actionable trades. I love that we recaptured the 50-week moving average. And in fact, every sort of level that we climb above is sort of like a new checkpoint or a new milestone. because once we cross above a new milestone, then you can sort of add more leverage, and then in that sense you have a trailing stop. Because let's say once we bounce here, even if you add or if you didn't add, there isn't much you can do on the way up. But once we cross a new milestone, that becomes a new stop. So you can take on some more leverage, like right above that, and then if we break below this area, then you can take off leverage. And the great thing about these sort of stops and why I love moving averages so much is because they actually go with the trend. So um, by the time we do get another crash below, like a 50-week moving average, for example, this stop is a lot higher than where it was 2 years prior. So the stop levels actually move with the trend, which is great. Um, for now, and as far as what I see, I'm still debating on what the new stop should be. I really, really do like the 7-day moving average. I've been liking this one for about maybe a year and a half now. Especially once we're above the 200-day moving average, then it's even more powerful. So I'm pretty close to fully leveraged right now. I've been fully leveraged. I've been adding sort of as we saw improvements. And yeah, so if we break below the cyan line, then I will go ahead and probably take some risk off and then take more risk off, or nearly all the risk off if we break below the 200-day moving average on the Nasdaq. Yeah, and couple things here that I want to note. So if we zoom out once again, the crazy thing is that the Nasdaq is probably the most bullish index, and I've said that before, but this is just like proof as to why it's my favorite index. So see sort of how like in 2008 this moving average was significant, and here it was also significant as well. And then if we go to the S&P 500 or the Dow Jones, the same thing can be said, except that there's so much more of a divergence here. So on the S&P 500, we actually broke below the 200-week moving average. Even though it was the same sort of picture here, you're starting to notice the difference in performance for the Nasdaq, especially over the past 4 years or so, where the Nasdaq just completely outperformed everything. In fact, the level that we bounced off of on the S&P 500 was probably closer to monthly time frame. Let me go ahead and edit this moving average just a little bit, and let's zoom out even more. So yeah, so the level that we bounced off of was the 100-month moving average, again to the penny. And so that's sort of how these support levels work. Is obviously you can see that during this rally, the 50-month acted as support numerous times. We actually closed above it this past month in March, or nearly above it. But once this level breaks, the next level to watch out for is this one. And so the same thing can be said up to the downside if we break below this level. So yeah, that's one thing I wanted to point out. And the other really cool thing about what I just showed is that because the S&P 500 has so much more work to do, that means that there's a lot more potential for getting leveraged as the trend improves. And so let me go ahead and explain what I mean by that. Let's go ahead and take this one off. It might be getting a little bit noisy. So during recessions, if we do break below the 200-week, then the 50-week, which is basically the 200-day moving average, this orange line, is going to act as resistance. Maybe we might get some closes above it, but I think largely in bear markets, this moving average, this orange one, is going to act as resistance. It did so in 08, and it did so in 2000. As you can see, let me go ahead and make that even cleaner. It acted as resistance here, and it acted as resistance here on the way down. And as soon as we were getting consecutive closes above this moving average, then the trend sort of shifted. And so we're not exactly there yet on the S&P 500. I think that would be the last sort of check mark on my list before I would get even more leveraged. So I'm playing a little bit safely right now. I don't really see the need to have to rush in too much. Obviously, when I say that, at the same time, I am pretty leveraged right now with tight stops, of course, but I am perfectly okay with taking on even more risk if we start to, if the trend starts to improve and if we start to recapture this area right here. So this next data point I want to show is hedge your net dollar position in basically the major indices. And so what it means is as we start to take on more risk, there are some investors that feel the need to have to hedge their positions more, which obviously makes sense. And so the really high spike in hedges actually precede large rallies. And obviously there isn't data going back to the 2008 recession, but if the trend were to improve significantly, let's say the retracement starts to get pretty high on the major indices, then we will start to see short covering. And obviously that short covering has to go somewhere. Like hedgers have to buy back their shares or else they're going to get cooked. And so in my opinion, that's why these sorts of data points actually precede large rallies. The next data point that I want to show is the dark pools buying index, and you get to see sort of large order flow coming in through the dark pools. Dark pools are basically when institutional buyers or really large buyers want to make large purchases and they want to be avoided by the public, as well as they want to get a good fill in on their prices. They will go through the dark pools, and basically, let me go ahead and get rid of this. So this is points in time in which large institutional buying stepped in. This is all of 2011. This is around the 2015. This is around 2020 right now. And so if I go ahead and throw back on the S&P 500, we can see that institutional buyers really stepped in right before large rallies. So here, the first sign of a bear market in 2015 was a really big spike. And then there was another sort of medium-sized spike in institutional buying about a year later, and obviously that preceded a really large rally. And you guys can see as the rally sort of unfolds, then institutional buyers do not step in. In fact, you see a pretty clear downtrend in institutional buying as the rally lives on. Especially like if you start to see divergences. If I look at where this rally topped, you can see the divergences in institutional buying. So there was a spike around here, around 47%. There was another spike around here, around 46%, and then another spike here around 43%. And so you can see that buyers or large buyers are not stepping in towards the end of some rallies. And then the last spike that I didn't address was here around 2011, and this is pretty close to when the new bull market started. And so obviously that preceded a really large rally. And as the rally sort of unfolds, then you start to see a pretty clear downtrend in buyers stepping in. On the flip side, what we're seeing is retail and investors through ETFs and mutual funds starting to flee right now. As you guys can see from these red data points, the further they are to the downside, then the larger the spikes in outflows. And so these outflows also precede really large rallies because as the rallies continue to unfold, then retail and ETFs and mutual funds tend to see more inflows, meaning that people start to chase the rallies. And obviously, like as the market starts to break down, then people don't want to be in the market during those points. So I do have a few more data points, but I don't want this video to get too long, so I'll leave it at that. But that's basically the picture that I want to point, and I think now is a pretty good time to say that, obviously I could be wrong on everything, and this doesn't mean that I think the volatility is going to be done and we're going to be in a V-shaped reversal for good. I am keeping that possibility open in the V-shaped reversal despite everything that's going on right now. But my strategy right now is to keep a tight stop. Obviously, if things start to turn for the worse, that's going to be pretty unfortunate, and I am going to have to exit my positions. But as we start to improve in trend, and I get to take on more leverage, which is obviously what I want, and I'm trying to create a win-win scenario for myself. Because if the market rallies from here and there are very little pullbacks, then I am leveraged the appropriate amount, in my opinion, to take advantage of that. But if the trend in the short term starts to decay a little bit, then obviously I can exit. I showed you guys the moving averages that I'm using. It's basically the 7-day moving average, 50-day moving average, and 200-day moving average as sort of the health of this market, in my opinion. Fortunately, we're not too far away from those, so I get to keep a pretty tight stop. And then that's good for me too, because if I do get stopped out, then I get to add in at cheaper prices or just, I could be a lot more flexible at that point. And if we do really start to unravel and I'm not in the market, then that's even better for me. Uh, so yeah, I guess the question we're all wondering is, how's my account doing? So my account's not doing the best, I would say. So I'm currently down close to 10-ish% year to date. I started the year at 126,000. It is what it is. I did make some really bad mistakes actually on the way down. The screwed up part is that when this drop happened, I actually got out like pretty well, and I was like, wow, I'm so far ahead of the curve right now. Um, and I made some really overconfident trades. I think the worst day was March 11th. I was just so confident, and it's probably the worst thing I could have done. Even though like there was very little that justified the sort of action I took. I just said like I'm gonna do it anyway, and yeah, it ended up being one of the most costly mistakes ever. But the thing about life and the market is that like even if you take punches, that's sort of half the skill. I mean, I can't emphasize enough how important it is to be able to take punches, because I could have just as easily been like, okay, I took a punch, like I don't want to be in this anymore, like I'm out. But obviously that's super important. But just as important, if not more, is to be able to punch back just as hard. So even if the market hits you, you got to be able to hit it back. And I think that's also another one of my skills, is being able to get back even if I'm not like even if I'm down, or even if I'm a little hobbled, so to speak. So that's pretty much where I'm at. I'm still pretty optimistic about my strategy right now. Just because I took a hit doesn't mean I can't recover. And to be honest, this is going to sound pretty crazy, but I still think that 200K is still possible this year. So yeah, I mean, we'll see if it happens. How are you guys doing? Let me know what you think. I hope your accounts are doing well. And let me know what you guys think about all my opinions in this video. Very curious. Maybe we can start like a little bit of a dialogue. Yeah, I hope that you guys are healthy first and foremost. I hope that the job situation is treating you well. Obviously, like people are getting laid off, and there's like pay cuts and stuff like that, which kind of sucks. Um, and like I'm feeling the effects of it too, so that's partially why I haven't been around. But yeah, regardless, I hope you guys are doing well. Hope you guys are staying safe. Like I said, I'm not gonna put a date on exactly when I come back. I do want to come back. It's just not a good time for me. But yeah, I'll see you guys when I see you, and hope you guys are doing well.